18th year we're holding this event, and it's an event that is very dear to us. I'm particularly proud of two things. Number one, to let me share with you, on May 10th, we were in Shanghai, where we hosted a tremendous maritime conference. On May 14th, we were in Tokyo, where we hosted another tremendous maritime conference. And on May 22, we're in New York hosting a wonderful closed-end fund and ETF event. So I would like to say a tremendous thanks to my staff. I'm only the team leader. So I'd like to thank my staff. I'd like to thank in particular Eleni Day, who coordinates our conference worldwide. And you all know Annie Zhu. I'd like to thank Annie for working with me on this conference and on business development. And now we have a new Annie on our team who joined us, and she will be working with you as well on global funds and ETFs. So the second reason I'm very proud is because this event, 18 years, I think we are the only private sector initiative that has withstood the test of time. And despite the ups and downs of the sector, we have been here every year delivering a quality event. But why do we do that? Not only because we have good and dedicated staff, but because we have good friends in the industry who value our work and who support it year after year. So a tremendous thanks from us to you, to the sponsors, to the speakers, to the panelists for your So a tremendous thanks to all of you for your loyalty, your support, which allows us every year to continue doing this work. I would like to acknowledge the partnership of the New York Stock Exchange. We have with them a very long-standing relationship. I'm particularly happy to acknowledge this year the support and involvement of Closed-End Fund Association of CIFA. I think the motto is there's strength in unity, and I'm delighted that we are working together, and I hope our cooperation will flourish and develop more. So again, thanks to the sponsors, thank you to everybody, and now let me introduce to you our keynote speaker, Jan van Eck. I don't really think that Jan needs an introduction, but still I will focus on a few key elements of his career. Jan is joined Van Eck Corporation in 1982 and is the President, Chief Executive Officer, and an owner of Van Eck Corporation, and of course is serving as a Senior Manager, President, or Chief Executive Officer on many of the funds of this organization. One of the main, and Jan has many accomplishments, but one of them is the fact that in 2006, he established the ETF segment of Van Eck Corporation, and under his management and vision, the ETF side has now come to the point of management, if I'm not mistaken, about 34 billion, and is still growing. Also Jan, as you can see, is always a thought leader. He's always at the forefront of developments in the industry. And we're delighted that today he's going to speak to us. I'm not going to reveal about what, because he told me before. I think it's very interesting. But I will only say that Jan, among many positions, is also a director of the National Committee on United States-China Relations. So I think that's a particularly interesting and timely position to have right now. And of course, as you know, he has routinely appeared on CNBC, on Bloomberg, and he was a 2013 finalist for Institutional Investors Fund Leader of the Year. So ladies and gentlemen, let me invite Jan van Eck to the podium and thank him for being with us today as our keynote speaker. And again, thank you to all of you.
Thank you, Nicholas. It's a very extremely generous background. Thank you for including me, and thanks to all of you for your attention. It's great to see some friends in the room, almost at every table. Hopefully you won't be in the middle of the talk. So my thought is just to maybe talk for about 20 minutes or so and then open it up to questions and answers if you have any. My general topics, I do want to talk about China a little bit and and crypto and Bitcoin. Nicholas was kind enough to allow me to title the talk very open-ended because I'm not sure what I wanted to say a month ago, and every Bitcoin gets a lot of clicks, so I said, well, we got to talk about crypto a little bit. So I will try to give you some predictions about the future. That's how I'm approaching my talk today. What are the things that are likely to happen in the next 5 years, and what should we as investors do about it? Obviously, making predictions about the future is stupid in a way, but I'll tell you, I do feel strongly not about my predictions, but about and some things and how to think about some of the events that are almost for sure going to happen in the next 5 years. So first set of things I wanted to talk about is China. China, its impact on growth, what's happening on the technology front, and its impact on the portfolio. My background in China is I started traveling there in 1992. We did a joint venture from 94 to 98, which we sold at a profit. We restarted an office there and just got a wholly owned subsidiary license, one of 30 foreign money managers to be able to do that. And I've been there over 50 times. It's sort of a hobby interest of mine. What I say from an investment perspective is you can't come to the office, your first business day in January, without having a view of what China's economy is going to do. And that's the reason I want to talk about it, because as the second largest economy in the world, its economic cycle affects almost every asset class, certainly emerging market equities, certainly commodities, but I think because of commodities indirectly high yield, like in 2015, when energy bonds were cratering, why was there was demand concerns about China that drove oil to $25 a barrel. So I actually, I'm going to overpromise and I'm going to give you a deliverable, because my question is always, how do we know how China is doing? As some of you guys know, I'm a big hockey fan. So like, how are the Islanders winning? Are they losing? It's easy. You put it in your Google. And I find it really frustrating because there are a lot of statistics. You read a lot of pundits saying China's going to implode, the property market is collapsing, there's too much inventory, the renminbi is about to be incinerated. So what's happening? So I'm going to offer you a proposed solution, and I'm actually going to ask you to do something that probably no speaker has ever done, which is bring out your smartphones. And I'm serious. Open it up to a browser, because it's going to have two charts which I believe answer this question, and I'm going to talk about those charts. So if you put in there Jan Van Eck, Jan Van Eck, ECK, how is China doing? We just posted this blog yesterday. And so Jan Van Eck, has anyone found this page? You have to click through like all these cookies things. Has anyone found it? Jan Van Eck, how is China doing? No? Islands are winning, all right. Oh, they got swept. Has anyone found it yet? So, how is China doing? And then don't click on the video one, click on the blog one. This could be a complete failure, but that's okay, I'm going to keep talking. Did anyone find it? Okay, so there's only two charts, and my sales pitch is these are the only two charts you will ever need to know what's going on in China. Okay? The first chart, whether you have it or not, is Purchasing Manager Index, PMI, and there's two charts. One is manufacturing, and the second is non-manufacturing, let's call it services. So the manufacturing PMI hovers around the 50 mark, and 50 is expansionary. So above 50 is expansionary, below 50 is contractionary. And this is where I think is the statistic to look at whether China is in trouble or not. Because their GDP is always 6%, right? That's not helpful to you, and it's not helpful to anyone understanding what's going on in the cycles in China. But manufacturing PMI is. So you see at the end of 2015 it turned negative, right? That is when old China was collapsing, right? Steel, capital was going less to steel, aluminum factories and all that kind of stuff. And that's when new China was emerging, that theme, right? And new China is the top line. So you see new China has been expansionary for years in the 50s numbers, way, way above 50. So if you only looked at that number, you'd say, China's doing great. Why are they freaking out, right? It's the manufacturing PMI, which turned negative in the second half of last year, which is what was concerning. Okay, the other PMI that was collapsing last year. Which country's PMI was absolutely collapsing like a cliff dive? Germany. So I think that economic collapse, that's what's hit the markets, I think, and that's what the equity market started pricing in the fourth quarter, and that's why I think this is an important statistic to look at. So what happened in the beginning of last summer, 2018, is the Chinese government realized we're seeing a slowdown, right? They have their fingers on the pulse of the economy, so that they saw that PMI going down, and that's when they started what we call drip stimulus measures. So it wasn't throwing trillions of dollars at the economy like they did during the financial crisis, but they started fiscal tax cuts, they started some monetary loosening, reserve requirement cuts. I don't know, the number was something like 70 different stimulus cuts that they did. And what you see, if you can actually find this blog or find the statistics somewhere else, is that PMI started turning up about a month ago, which is entirely predictable, right? The whole world, our world is very simple. It all comes down to only one thing: what's the central bank doing? And since the PBOC was stimulating in the second half of last year, you knew their economy was going to turn around. Now, maybe sugar medicine and may have problems with that, but that's kind of the backdrop to what is going on in China as it cycles through going forward. So that's my sales slide number one on what's going on in China. The next slide below it, if you're still on the page, is the other part of the story, which was why was their economy slowing down so much in the second half of last year? It's all about the central bank. So what you see in that second slide is that China has two credit systems effectively. One is for state-owned enterprises, because that's a huge part of their economy, and you'll see that interest rates didn't move at all. Yes, Xi Jinping's friends always get money, and the price of that money is always cheap. But the cost of credit to private enterprises, you'll see, was going up steeply last year. And that's what people were concerned about. So that credit cutoff is what hurt private enterprise last year and caused their economy, their manufacturing PMIs to sink. So that's the narrative. And so when you saw that interest rate spike level off, it hasn't come down yet, but you saw it level off, basically the China recovery cycle was likely to be okay. And guess what? Got reflected in the equity markets. So Q1, right, the economy, credit is coming back, central bank is stimulative, sure enough, with a 3 to 6 month lag, boom, it kicks into their financial markets. So I don't know, that's my sales pitch. If you want to know what's going on in China, amongst all the statistics, I think those are the kind of the best statistics to kind of look for. So quickly finishing up on China, looking ahead. So if they're stimulating, and you always follow the central bank, the rest of this year should be okay in terms of emerging market equity markets. Because if the US is growing and China growing, we've got financial markets should be okay. So that's my little market prediction there. Again, over the next 5 years, what's one thing that we absolutely know? And here's my question to you. Is it 20 or is it 5? So how big is China going to be in your global equity portfolios in the next 5 years? If you use market cap weighting or use GDP statistics, it should be 20%. If you actually use those weightings in an emerging market index, it would blow up emerging markets as an asset class because China would be half of it. So my question to you in your investment committee meetings on the first day of January next year and every year for the rest of your careers is, how big is China going to be? And the great thing about our industry is we have no answer. That's what I love about our industry. It's just, one index firm decides to arbitrarily start changing that number. You can follow that. But I think it's just a really important question that we've been asking ourselves. I think we're probably at 10. I think we would handicap China because we're concerned about the transparent, we're stock pickers in one part of our company, concerned about the transparency of their companies. There's obviously political risk. And there's just a very interventionist government policy, so we would probably be a little bit less than that. And that's sort of how Russia has been treated in the EM portfolios as well. So anyway, but I think that's a big question to think about, because if you just follow the course of events, China would blow up your emerging market equities asset class allocation. And I think it has to be considered separately anyway. Okay, quickly on crypto, and then I'll open up to questions. So I'm going to predict the price of Bitcoin in a second. But before I get there, no slides needed, I guess I would just make one point, which is, I've called this the year of singles for crypto assets. The world, I hate the word crypto, but it's the only word to use, and I feel like a fool when I use it. But anyway, the crypto ecosystem is alive and thriving despite the big bear market of last year. And let me just give you a couple of reference points for that. The core surviving part of the crypto ecosystem are the crypto exchanges. And Bitfinex, which is one I follow a lot, sort of headquartered in Hong Kong, made $400 million US last year. Of publicly listed companies in the US, that single crypto exchange would rank in the top 650. So it's a real enterprise, and their revenue is like 400, and their expenses are like 16 billion for programmers. It's a crazy, nice business to think about. Clients, right? We know Coinbase, if you follow Coinbase based in California, had accumulated almost as many clients as Schwab in the course of 3 years. Now, probably a lot of them are very disappointed millennials, but it's still a big, sizable number, and I'd be happy to have 15 million clients at VanEck. Absolutely. I think all of us would. And then there are technology developments that are bringing it into our lives, whether we like it or not, the traditional world, whether the SEC likes it or not. So first of all, on the payments front, a company called Square, a big payments company, has enabled Bitcoin transactions on their Cash App, and there was over 150 million Bitcoin-oriented transactions, I guess, last quarter of last year, in Bitcoin. So people are using it on Square. Gemini just announced at this big conference last week, Gemini just announced that they've done a JV that allows you to pay for your Starbucks coffee with Bitcoin. And a bunch of other major brand name retailers. And what's the benefit to them? They don't have to change their computer system, so Howard Schultz ain't changing the Starbucks system. But they save, merchandisers have to pay 2.5% back to Visa. Guess what? With Bitcoin, they don't have to do that. So I don't know what the take-up will be, obviously, but you, out of your wallet today, can use Bitcoin in these kinds of venues. Stable coins, just to talk on some other developments that I think are important to note since I'm giving the talk on this. Stable coins are meant to track the US dollar, basically, and the volume in stable coins is tremendous. The biggest stable coin is about 2 billion. I'm not going to kind of go into it now, but if you're not familiar with that phenomenon, I suggest that that's going to be important going forward in the next 5 years. And the last thing, and this is entirely speculative, is what they call tokenization. So our ETFs trade on the New York Stock Exchange, great sponsor. Where's the competition? Will there be ETF tokens that trade on the Bitfinex stock exchange? I don't know. I think, as I said, it's speculative, and I'm not predicting it, but that's something that a lot of people are thinking about and working on, because their ecosystem is so much more efficient than the old, mainframe-based ecosystem of T+2 security settlement that we're all used to dealing with. It's instantaneous, and that's one of the appeals. Okay, so my last comment is, what's the price going to happen to the price of Bitcoin? So I'll say my credibility on this is only that I did say with a colleague in December of 2017 that the downside on Bitcoin was 80 to 90%, and I guess we were right. And it's very simple. I've looked at this asset. It's a 10-year-old asset, and the previous corrections have been 80 or 90%. Bitcoin, after doing that, has never not hit an all-time high. So my prediction is Bitcoin will hit an all-time high in the next 5 years. The benchmark that you probably don't know about, and maybe you can time a conference around it. Tomorrow's the 23rd of May. On the 23rd of May in 2020, Bitcoin mining will halve. So there will be half the amount of supply of new Bitcoins coming to the market, and that scarcity value. We'll see what happens. It's a speculative technology to a certain extent, but that could be something that people start focusing on, and I'm not going to say there's a fundamental value to Bitcoin. The last thing I just note is why are we as a firm involved in it, and it's because 2 years ago we decided that, listen, we've been involved in gold since the 1960s for a certain type of generation. Eventually Bitcoin could evolve into being a store of value, competitive with gold. I'll put it alternatively. If we get into a big war or trade fight or inflationary cycle, what's going to benefit more, Bitcoin or gold? I'd rather own a little bit of both. So that's it. Thank you for your interest, and I'd love to answer your questions.
I'm thinking of the security. I read every couple of weeks hundreds of millions of some of South Korean accounts.
Right. Hacking is definitely the biggest negative. If you look at the two negatives over the last year, for sure, the constant hacks. We'll see what, the Binance was just about, I want to say $40 million in magnitude, so it's a lot. Now, remember the first point I made is these exchanges are so rich that they actually have so much money that they reimburse those hacks. So you probably don't read about that, and I'm not saying that gives you comfort level. There's just a lot of risk around the hot wallet treatment, and ultimately it's like it's a bearer asset. It's like gold, right? And if you don't have a lot of controls over those keys, or if you have internal theft or malware, then that's the operational risk. And probably one of the concerns for a Bitcoin ETF is the custody, what they call the custody issue, more than I understood. So yeah, it's a negative, but the space is moving. It hasn't killed the overall trend. Yeah.
Let me ask you a question, and perhaps it's a somewhat skeptical view of Bitcoin, and maybe you can push back on it. When I pull a piece of currency out of my wallet, whether it's a $1 bill or a 5 or 100 or anything in between, granted, it's not backed by gold anymore, it's not backed by silver anymore, but there is that inscription there that this note is legal tender for all debts, public and private. Whereas with Bitcoin, I don't know what backs it. So why would I be incorrect in assuming that this is nothing more than a Ponzi scheme? And I'm not trying to make an accusation. I'm merely trying to put the case that I hear from lots of people who are skeptical about it, and I'd like to see your views on it.
Sure. I mean, look, there's no paper currency that's lasted as long as gold, right?
Right.
So why does the crowd? Then the issue is, well, why does the crowd value gold? I really have no idea. Right? It's almost like modern art. It's like Warren Buffett will say, like a lot of investors will say, listen, it doesn't generate income, so why do I care about it? I'd rather own companies, or I'd rather own fixed income. And I can't really fight against that. I just would say that Bitcoin is a hedge against governments, because eventually your dollar is going to be worthless. Now, it may not be in your lifetime, but every empire, the longest empire and it used gold backed was the Ottoman Empire, and it lasted, I think, whatever, 600-800 years. But sooner or later, paper currency devalues. And why? Because they can't stop spending. Kings, rulers can't stop spending. So it depends on, I would say, a little bit on what your time horizon is and your personal need for a hedge. If you don't have a need for a hedge and you have a long time horizon, yeah, I kind of agree. So I try to phrase it that way. I don't know, does that?
Sure.
Yeah.
What's your view on the tariff trade war between the United States and China and its impact on the prospects for growth in either country or both countries?
Right, so I think growth is independent, pretty independent of the tariff wars, right? So I think it's the central banks win, and each country is big enough to kind of manage its own cycles. I do think that where the countries are in the cycles has affected their mentality a little bit, and so that China is recovering now. I think they're like, we'll push back against the US a little bit. I would say, secondly, that we don't like each other, and we don't like the fact that China is not played by the rules. 80% of global counterfeiting comes out of China. The IP theft is high, and I think reading between lines, I know this for a fact, but the cybersecurity hacking, I think, has started again or continued out of China in a way that we wouldn't know, or the administration's not telling us. So I would say trade war itself, I think it's an opportunity to buy because I can't see tariffs going from 25 to 50%. I mean, I think it's one thing to nick your economy, it's another thing to run it over with a truck the year before you're up for election. So I think that's kind of priced in. I think what is not well understood in the U.S. is the technology decoupling, and this Huawei issue is huge. And you know, I will describe it that let's assume, none of us knows that Huawei is actually controlled by the Chinese military, and that they were trying to make a grab for not just breaking into systems, but like being able to break into all our security and communication systems at will. I'm not sure how they would use that, but the administration has said that's not happening. So that means that there might be quid pro quo sort of fights over Apple phone sales in China or Qualcomm licensing in China, because we just have just said, and the West has said, it's not just we, and it's bipartisan, enough is enough. And so I call that decoupling, and I think that's absolutely going to happen from the military. You know, it won't implode their economy, it won't implode their stock market. There'll be plenty of great companies there, but I think it's a political reality. So that's interwoven, I think, with this trade war. Does that make sense?
Yeah.
Yeah.
One point that you haven't touched upon is the shrinking demographics in China. The one child, one family policy, which was implemented in the 70s, obviously now, as that group would have been in their 40s, is coming into play.
Right.
The Journal had an article on this a couple of days ago, you might have seen it, about the shrinking demographic, aging population now, the 40-year-olds that aren't there, not to support them. How does that factor into your thinking about Chinese growth going forward?
So I guess, you know, I talked about the charts before I finally said, wow, I've got two charts that I think everyone should look at. I was asking a bunch of experts, what is Chinese growth? It's amazing, like there are not many, Brookings actually has a really good study on this, but there are not many people that can answer that question or have looked at it really thoroughly because there's so many bad statistics out there. So this is a little bit speculative, but the way I look at the Chinese economy is probably only growing 2 to 4% a year, and I think that their favoring of SOEs is hurting them by like 1 to 2% a year. And I say that, I'll just give you an example. So we hired at the head of our office in China someone who had built a great asset management business in Hong Kong, and he did it for a big bank, so he benefited that, but he still had to do it with very few resources. And then they told him he lost his job. And you know why? Why did he lose his job?
Someone else.
But why?
Someone from the government. Someone from the
Sort
government.
of. He's not a party member. He's not a Communist Party member. That's not a great way to run your economy. That is a huge chunk of their economy. So I think they're hurting themselves, you know, that way going forward. So I know that's kind of how I frame the thinking about that. Does that make sense?
So the demographics are just...
Sorry, demographics as well, sure. Their labor force has maximized, right? It's peaked. It was a year or two ago, and that absolutely will be a drag. There's offsetting things because they have a high savings rate, and there's lots of different things going on there. I think the additional point I would make is that, like I said with the example for our company, intellectual capital doesn't want to hang. That's really important in the economy these days, and I think Chinese people will want a foot out of China, right? The entrepreneurial ones will want a footprint in Hong Kong, Taiwan, or the U.S. So I think that'll hurt them, but I don't think the government people care at all. So, and I'm not sure the growth of the region, that's a little bit of a harder thing to say. Yeah.
Talk a little bit about that B-shares versus A-shares
Sure. Just the different share structures, I guess, of Chinese companies. And I mean, the reason they're going to be in your portfolios is because their capital controls are reducing. So the Stock Connect program has opened up their equity markets and continues to, and their fixed income markets are totally open. So those share arbitrages have narrowed over time. Is that what you're asking about? Yeah. The other point, actually, thank you for reminding me, really important point about China being in your portfolios. China, 5 years ago in your portfolio was Hong Kong stocks. And Hong Kong's, because they're linked pegged to the dollar, they would behave almost like US stocks because they're tied to the same monetary cycle. Over the last year, statistically, they've started trading much more with China, which makes sense, with Chinese A-share equities. So the China in your portfolio, I guess this is a positive spin, going forward over the next 5 years, will be much more part of the renminbi world than it will be out of the Hong Kong, US. At least that's the way it's behaving now, and I would expect that trend to continue. Can we get one more? Or?
Yeah, I think Rich had a question.
Okay.
China or India?
Next speaker. I don't know. But I will say, we've been asking clients about like how do you size China, and one of my colleagues met with someone that said, forget emerging markets, I'm sizing India here and China here, meaning they were making that, sort of structural multi-year bet, and I think it's a great way to think about it. I don't know. That's a whole 5-hour discussion, I think, probably. Yeah.
Yeah. Question. The U.S. budget deficit right now is basically growing at a rate greater than our GDP growth.
Yeah.
Right. We've got what is the highest percentage of graduate students 5 years after graduating that who are underemployed. Right. We have housing industry is in the tank. The auto industry has turned down sharply. So I'm wondering, what is there in the United States right now, given that Baltic Dry Index, global economies are really moving? How can this economy continue to go up?
It's a question about the U.S. economy and a lot of structural headwinds, including government deficits and things like that. I can't really address all those, kind of longer term issues. The economy seems to be growing right now, and I don't see any bubbles. I guess I always look for the outliers. I don't see any bubbles right now. And I would say the Fed is accommodated. And I just say for all of us, like it's all about the central bank. Everything you mentioned is okay and interesting, but it's all about the Fed. The Fed, way better than Europe, has the ammunition to go back, to cut rates, and to do another QE cycle. I mean, I know that's a little bit short term, next 5-10 years oriented, but we at least live in a country that has a central bank that has some bullets. What's the ECB going to do? Take rates from -1 to -5%? I mean, what's their financial sector going to look like? So I guess it's the cleanest shirt in the laundry, right? So, all right. Well, thank you very much.
Jan, thank you for a very insightful and above all very lively delivery. I really tremendous. Thank you so much. And dear friends, thanks for being with us today. Thanks for the lunch. Let's go down. We have the afternoon sessions. They're equally interesting, and I promise we have reserved a seat for you. So please come back down. Thank you.